By early 2026, billions of dollars were still flowing into Dubai's luxury economy. Ultra-premium property deals continued closing. Private jets still landed daily. The skyline still looked unstoppable. But beneath the surface, something quietly started changing. Some investors, who once rushed aggressively into Dubai's luxury market, appeared to become noticeably more cautious. In certain periods during late 2025 and early 2026, reports suggested transaction activity in parts of the ultra-luxury sector had begun slowing compared to the explosive momentum seen just 2 years earlier. And that shift matters more than it first appears, because billionaire behavior rarely changes loudly. It changes quietly, slowly, then all at once. For more than a decade, Dubai built one of the most powerful luxury growth stories in the world. By 2024, the city's economy continued expanding at an estimated 3 to 4%. Population growth accelerated past 3.7 million residents, and international wealth migration pushed demand for ultra-premium assets into record territory. Luxury penthouses above $10 million sold at unprecedented levels. Palm Jumeirah villas reached prices that once seemed impossible. Branded residences linked to luxury hotels and global fashion names expanded rapidly across the skyline. And the timing looked perfect. While many global cities struggled with taxes, regulation, political uncertainty, or slowing growth, Dubai positioned itself as a high-speed sanctuary for international capital. Billionaires from Europe, Russia, India, Africa, and parts of Asia increasingly viewed the city as a place where wealth could move freely, grow quickly, and remain protected. The result was explosive momentum. In some luxury launches during 2023 and early 2024, developers reportedly sold large portions of inventory within hours. The message felt clear. Dubai's luxury economy had become one of the safest and fastest-growing wealth stories on Earth. Markets driven by extreme confidence often become most fragile precisely when nobody believes the momentum can slow. By late 2025 and early 2026, the first warning signs did not appear through dramatic headlines or obvious collapse. They appeared through subtle behavioral changes among the people closest to the money. Some brokers in Dubai's ultra-luxury market began quietly noticing that billionaire buyers were taking longer to commit. Private viewings still happened. High-end events still looked glamorous. But the urgency that dominated 2023 and early 2024 had started fading. In certain premium segments, reports suggested transaction activity slowed compared to the peak momentum period, while some luxury listings reportedly remained active longer than expected. And there were visible signals too. Development pipelines indicated that tens of thousands of additional premium and luxury units could enter the market over the next several years, including a growing wave of branded residences and ultra-high-end towers targeting global wealth. That changes psychology quickly. Because billionaire markets rely heavily on exclusivity and scarcity, once investors begin believing supply may outpace urgency, behavior shifts almost immediately. Analysts also started observing that some wealthy buyers appeared increasingly focused on liquidity, timing, and long-term sustainability instead of rapid appreciation. The skyline still looked rich, the towers still glowed at night, but underneath the surface, some of the emotional energy driving Dubai's luxury boom was beginning to cool. Over the past several years, Dubai attracted enormous amounts of global capital into luxury real estate, private wealth ecosystems, and ultra-premium development projects. In 2024 alone, luxury transaction volumes reached record territory in several segments, with properties above $10 million becoming one of the fastest-growing categories in the market. Wealth migration accelerated as high-net-worth individuals moved money into Dubai, seeking tax advantages, geopolitical flexibility, and access to a rapidly expanding global hub. But while capital inflows remained strong, supply accelerated aggressively at the same time. Reports and development pipelines suggested that more than 200,000 residential units could enter the broader Dubai market by the end of the decade, including a large concentration of luxury and branded inventory. And that changes the equation. Because billionaire markets depend heavily on scarcity psychology, once wealthy buyers believe endless luxury supply is still coming, urgency weakens naturally. By early 2026, some analysts began noticing that price growth in parts of the ultra-prime segment appeared to moderate compared to the explosive gains seen during 2023 and early 2024. Not collapse, moderation. But psychologically, moderation changes billionaire behavior very quickly. At the same time, global financing conditions became more difficult. Higher interest rates increased the cost of capital worldwide. Luxury developers faced rising construction expenses, elevated labor costs, and pressure to maintain ultra-premium quality across increasingly competitive projects. Then came the demand shift. Some billionaires still viewed Dubai as one of the world's strongest luxury destinations, but others appeared increasingly cautious, selective, and patient. Instead of rushing into trophy assets immediately, wealthy buyers started comparing projects longer, negotiating harder, and preserving liquidity more carefully. Years, the dominant fear was missing out. By early 2026, parts of Dubai's billionaire market increasingly appeared driven by a very different fear entirely, becoming overexposed to a cycle that may already be slowing underneath the surface. For many people living inside Dubai, the shift in billionaire behavior did not feel isolated from everyday life. Between 2022 and 2025, rents across several major districts reportedly increased by more than 30 to 50%, depending on location and property type. School fees climbed, service charges rose. Maintaining even a comfortable middle-class lifestyle became significantly heavier as luxury expansion accelerated across the city. And that created a strange contradiction. Dubai looked richer than ever from the outside. New towers kept rising, luxury brands kept arriving, billionaires still bought penthouses and waterfront villas. But underneath the visible prosperity, pressure quietly spread through the broader population supporting the system. Some professionals began relocating to cheaper Emirates. Others downsized apartments despite strong salaries. More residents adjusted lifestyles around rising costs and longer commuting patterns. The skyline still glowed beautifully at night, but increasingly the city felt divided between ultra-luxury growth at the top and mounting affordability pressure underneath it. And historically, that matters more than many investors realize, because even billionaire ecosystems ultimately depend on whether the broader economic foundation beneath them remains stable long-term. Several forces appear to be driving why some billionaires are quietly pulling back from Dubai, and none of them alone seem powerful enough to break the system completely. That is what makes the shift so difficult to detect clearly. The first cause is oversupply pressure. During the explosive luxury boom between 2022 and 2025, developers accelerated aggressively into branded residences, ultra-premium towers, waterfront mansions, and luxury mixed-use projects. More supply entered the pipeline precisely because demand looked unstoppable. But billionaire markets depend heavily on exclusivity. Buyers begin believing that endless new luxury inventory is still coming. Scarcity loses psychological power very quickly. The second cause is global liquidity conditions. Since 2022, higher interest rates changed the behavior of capital worldwide. Safer assets suddenly started generating meaningful returns again, reducing the urgency to aggressively chase luxury property appreciation. Billionaires became more selective with large allocations. The third cause is behavioral fatigue. During peak momentum, many ultra-wealthy buyers entered Dubai expecting rapid appreciation, strong rental demand, and fast wealth preservation advantages. Once price growth moderates even slightly, behavior changes. Investors begin protecting liquidity. Negotiations become harder. decision timelines stretch longer. The fourth cause is geopolitical uncertainty. Dubai benefited enormously from global instability by attracting wealth-seeking safety and mobility. But the same uncertainty that drives money into Dubai can also make wealthy investors more cautious about concentrating too much exposure into any single market. And finally, there is the expectation problem. Dubai spent years building an image of unstoppable luxury growth. Systems built around acceleration eventually face a difficult reality. The faster expectations rise, the harder they become to sustain indefinitely. And once billionaire confidence becomes conditional instead of automatic, the emotional engine underneath the luxury market starts weakening far faster than the skyline suggests. To be fair, Dubai still remains one of the most attractive wealth hubs in the world. The city continues attracting high-net-worth migration at an extraordinary pace. Infrastructure expansion remains aggressive, tax advantages are still powerful, remain strong, and many investors continue viewing Dubai as relatively undervalued compared to ultra-prime markets like London, New York, or Hong Kong. In that sense, the bullish case is still very real. Some analysts even argue that the current slowdown in billionaire urgency simply reflects a healthier and more mature luxury market after the explosive momentum of 2023 and early 2024. But the opposing perspective is becoming harder to ignore. Future luxury supply, slowing momentum in some ultra-prime segments, rising affordability pressure inside the city, and increasingly cautious billionaire behavior are all signals that Dubai's luxury economy may be entering a far more sensitive phase psychologically. Not collapse, sensitivity. And highly confidence-driven systems often become vulnerable long before obvious weakness appears publicly. That is what makes this moment feel so unusual. Dubai still looks globally powerful, yet some of the behavior underneath increasingly resembles a market quietly trying to manage the consequences of growing too aggressively, too quickly, for too long. And this creates the decision trap now facing billionaires, investors, and even long-term residents across Dubai. Staying heavily exposed to the city still carries enormous upside potential. If global wealth migration continues, if tourism remains strong, and if Dubai successfully absorbs future luxury supply, today's caution may eventually look like nothing more than a temporary pause before another major expansion cycle. Investors who pull back too early could miss significant long-term gains in one of the world's fastest-growing wealth hubs. But staying aggressive carries risk too, because if the market is quietly becoming more fragile underneath the surface, then concentrating too much capital into ultra-luxury assets at peak pricing levels could become increasingly uncomfortable over the next several years. Luxury towers may take longer to fill. Price growth could normalize sharply. Resale liquidity may weaken. And psychologically, the shift is already becoming visible. During the boom years, the dominant fear among wealthy buyers was missing out. By early 2026, parts of Dubai's billionaire market increasingly appeared driven by a different fear entirely, becoming trapped inside a cycle that may already be slowing beneath the illusion of endless growth. Dubai may also reflect a much larger shift in global wealth behavior. Over the past decade, billionaires increasingly concentrated capital into a small number of international, safe wealth hubs, cities capable of combining luxury lifestyle, wealth preservation, tax efficiency, and geopolitical flexibility all at once. Dubai became one of the clearest examples of that model. But by early 2026, wealthy investors globally appeared to be changing strategy. Instead of chasing pure expansion and rapid appreciation, many began prioritizing liquidity, optionality, and resilience. Luxury real estate was no longer viewed only as a status symbol or growth asset. Increasingly, it became part of a broader defensive strategy tied to uncertainty itself. That changes how billionaire markets behave psychologically. Buyers become more patient, capital moves more cautiously, exclusivity matters more than speed, and suddenly, cities like Dubai are no longer competing only on growth. They are competing on long-term stability and confidence preservation. This is the deeper shift underneath the luxury story. The age of effortless billionaire momentum may be fading globally. Wealth still moves, luxury still sells. Investors increasingly appear unwilling to assume that every high-growth market can continue accelerating forever, without eventually becoming vulnerable to its own success. Dubai still looks like one of the richest and fastest-growing cities on Earth. The skyline still glows. Billionaires still arrive. Luxury towers continue rising into the desert. From the outside, the system still appears powerful. But underneath that image, behavior is changing. Wealthy investors are becoming more cautious. Buyers are taking longer to commit. Capital appears increasingly selective. And that may be the real signal hidden beneath the optimism. Billionaire markets rarely collapse suddenly at first. They begin with subtle shifts in confidence that most people ignore while the city still looks unstoppable. So this raises a difficult question. Is Dubai simply evolving into a more mature global wealth hub after years of explosive growth? Or are these the first signs of a system beginning to strain under the pressure of its own expansion? And more importantly, if even billionaires are quietly starting to pull back from Dubai, what exactly are they seeing beneath the surface that the rest of the world still does not?